Hello.
Hello. Uh, sir, the session is live.
Yep.
Uh, Good evening, friends. First of all, I would like to thank all the listeners for joining us for today's session. So our session will be topic for today's session is current trends and future outlook of ETF and index investing in India. And the speaker for today's session is Mr. Mukesh Agarwal, sir. First of all, I would like to thank Mukesh, sir, for joining us for today's session. Over to you, sir.
Um, Thanks, Mir, and good evening, everyone. And I hope you all are doing well. And thanks for logging in for today's session. Now, the topic, as Mir said, the topic for today's session is uh, current trends and future outlook for index investing, which is ETFs and index funds. But before I get into the main topic, I thought I should just recap of what is ETF, what is active investment, what is passive investment, because some of the questions which we have received from the participants are asking about what is ETF, what is the difference between ETF and index fund. So I thought I should take 5 minutes to uh, go through the concepts of ETFs and index investing, and then we will get into the trends and etc. Yeah, just give me 2 minutes. We'll load the PPT. Yeah, next slide. Yeah. So, as I said, we'll spend some time, about 5 minutes, on difference between passive and active, and what are the differences between index and active, to make sure that all of us are on the same page. And I would like to just, the people who have already attended the earlier sessions wherein we have discussed these differences, to just bear with us for 5 minutes, then we'll come to the main topic. Now, what are the passive and active funds? So basically, this slide talks about the differences between passive and active funds. So what is the objective? In the case of passive funds, they try to mimic the returns of the underlying index, which is basically underlying index reflects the performance of the market. So they try to deliver returns which are in line with the markets or the underlying index. Whereas the active funds is they try to outperform the markets. So they try to give higher returns than the market returns. So I think that is a basic difference. Now the strategy is, for passive funds, it is a hands-off investment approach. I'll talk more about it in detail. And for active funds, it is a active trading, wherein the fund manager takes an active call on what stocks to buy, what stocks to sell, and which sectors to take exposure to. Where in case of passive, it is totally hands-off. And but how do they invest? They invest basically. So basically, if you look at passive, what happens in passive? Passive, you are trying to mimic the any particular index. Let's say passive fund which is tracking Nifty 50. So they will mimic the portfolio which is similar to Nifty 50. Nifty 50 has 50 stocks, so they will buy the underlying 50 stocks in the same ratio. So today, Reliance has got the highest weightage, which is around 12.95%. So they will invest 12.95% in Reliance, around 8.5% in HDFC Bank, and so that is what they try to replicate the indices, wherein in active the fund manager is taking active call on what to buy, what to sell, so that they can outperform the underlying indices or the markets. And I have already discussed this. Next slide. Yeah. So in case of passive, the returns an investor will get will be very similar to the returns of the underlying index. So if you are investing in a passive fund which is linked to Nifty 50, the returns will be similar to Nifty 50. Wherein in case of active funds, the returns will depend on how the judgment and the calls taken by the fund managers, or whether they have gone right or wrong. Based on that, the returns will be variable, and they could be higher or lower than the market returns or the index returns. So what are the different instruments of passive funds? Basically, there are two instruments. One is called index funds. Second is called ETFs, as we normally call them. And ETFs are basically exchange traded funds. So these are the two instruments for making passive investments. And as I just mentioned earlier, the money in case of passive investments is invested exactly in the same stocks with identical weightages as that of the underlying index. I had just given an example of Nifty 50. So we will move to the next slide now. So now some of you have asked, what are the differences between ETFs and index funds? So basically ETFs, just like any stock, Reliance or HDFC or HDFC Bank or ICICI Bank, they trade on the stock exchange in the cash segment. And if you are investing in large amounts, now SEBI has recently released guidelines wherein if you're investing more than 25 crores, then you can buy the ETFs directly from the mutual funds also, the fund houses. Where in case of index funds, you have to always buy the index fund directly from the mutual funds. And now ETFs, as I said, they trade in the cash segment of the exchange. So the price at which they are trading will be linked to the live NAV. Live NAV is the NAV of the fund, underlying fund, at that point of time. So suppose in the morning, the NAV, if the Nifty goes up by 5%, the NAV will also go by 5%, and the ETF will also trade as compared to yesterday's closing price 5% up. So it will depend on the market conditions and linked to the live NAV, and based on which the prices will fluctuate. Whereas in case of index funds, it is linked to the end of day NAV. So just like when we buy active funds from the mutual fund, which they allot to us based on end of day NAV, NAV is net asset value. So which is same thing happens in index funds also, that we buy it from the mutual funds and they give it to us, or we get the units allotted to us at the end of day NAV. So I've already spoken about real-time pricing. Based on the market movements, the prices fluctuate, and one can definitely take use of the opportunity. The market has fallen and someone wants to get into the market, so they can buy the ETFs at that point in time at the lower price because the markets have gone up. Whereas in case of index funds, one cannot make use of the daily or intraday volatility. The NAV at which the units will be allotted will be end of day NAV based on the calculation done by the mutual funds. Yeah. So this slide summarizes the difference between ETFs and index funds again. So as I mentioned earlier, in ETFs, one can do real-time trading and pricing fluctuates in line with the movement in the markets. Whereas in index funds, that opportunity is not possible. And in case of ETFs, one can put limit orders, basically the limit at which I will buy and or I want to sell, the price at which I want to buy and sell. Whereas in case of index funds, again, that option is not available. And as already mentioned, it trades live on the stock exchanges. ETF trade live on the stock exchanges, where index funds don't trade. Again, is arbitrage possible between futures and cash market? That is possible in the case of ETFs because they trade on the exchange. Again, index fund, that is not possible. Is diversification possible with a single unit? Yes, because both ETFs and index funds, they are replicating the underlying index. That is why an index comprises, like Nifty 50 has got 50 stocks and various sectors. So when you buy an ETF, you are buying a diversified portfolio. So both through ETFs and index funds, as both of them replicate the underlying index, diversification of portfolio is possible. Intraday trading is possible in ETFs. I can buy in the morning, sell in the evening, depending on the market movements. Whereas in index funds, that is not possible. Exit load in ETFs is not there because in ETFs you're buying directly on the exchange. But if you buy on exchange, ETFs, in case of ETFs, while there is no exit load, but you will have some other associated costs like brokerages, custodial charges, etc. In case of index funds, their funds might have exit loads, and that will vary from fund to fund. And what is the period if you exit before which there will be exit load. Now, for holding ETFs, because you are buying them from the stock exchange, they trade in the stock exchange, one needs to have a demat account to keep your ETFs. Where in case of index funds, demat account is not must. One can also get it in physical forms through the statements sent by the mutual funds. These are the basic differences between ETFs and index funds. Yeah. Now, as I mentioned, ETFs trade, or ETFs or index funds are linked to underlying indices. And today, if you look at it, we can have ETFs in different categories. One is in equity. So today, equity, I will talk more about today we have equity ETFs or index funds totally available on around 54 indices like Nifty 50, Nifty Bank, then Nifty CPSE, Nifty IT, Nifty Automobile, Nifty Consumption. So there are various indices on which equity ETFs are available. Similarly, we also have fixed income indices. Fixed income indices basically are debt indices, and they track indices like Nifty Bharat Bond Index, which was launched in December 2019, or other indices like Nifty Gilt and Nifty SDL and other indices are there. Plus, we also have ETFs which are linked to gold prices or silver prices. These are called commodity ETFs. And last one is global indices on which ETFs are available, like Nasdaq 100, S&P 500, 50 plus, or Hang Seng indices. These are the various indices on which ETFs or index funds are available, passive products are available. How to select an ETF and index fund? This is a very basic question, because we have received a few questions which are linked to how can I go about selecting an ETF and index fund. So these are the few points an investor needs to keep in mind before selecting which particular ETF or index funds are one needs to buy. Because if you look at today ETFs, today we have 17 ETFs available on Nifty 50 ETF, it's Nifty 50 index. Similarly, we have around 17 index funds available on Nifty 50. Now, for an investor who wants to invest in Nifty 50, the question is, which particular ETF should I invest in, and which particular index which I should invest in if I have to choose between the 17 ETFs or index funds available on Nifty 50. So one would be size of the fund. Second, I would say, is the expense ratio. Expense ratio, lower the expense ratio, the better it is. Second, the third would be tracking error. Tracking error, again, is the tracking error basically measures the difference between the returns offered by the ETF or the index fund as compared to the underlying index. Yes, as I mentioned earlier, the passive funds are supposed to give the returns which are in line with the underlying index, but as they have some expenses and expense ratios, etc., or they might not be able to deploy the money on time. So because of which there is some difference between the returns offered by the passive fund as compared to the underlying index. So that difference is called tracking error. Lower the tracking error, the better it is. And for ETFs, there are two specific points. Higher the trading volume, the better it is. So you should try to invest in ETF which has got higher trading volumes. And second, trading volumes also results into lower impact cost, which is basically the bid and ask spread. Bid and ask spread is the best price at which one is willing to buy, or best price at which one is willing to sell. The difference between the two, the lower is the difference, the better it is. So I think these are the 4-5 points one needs to keep in mind before deciding which particular ETF or index funds one needs to invest in, after he or she has made a decision which particular index to invest in. Now, I think that was in brief about the passive investments, index funds, what are index funds, what are ETFs, what is passive investment, what is active. Now we will come to the topic for today's discussion, which is the current trend and future outlook. Now, this slide talks about, just compares the global scenario versus India. So if you look at the global markets, globally, the size of the ETF is around 8.85 trillion US dollars. 8.85 trillion means 8.85 lakh crore US dollars. It's in comparison, Indian market, the passive investment market, the size is rupees 5.01 trillion, which is 5.01 lakh crores. Now, if you look at the growth, the global ETF AUM is assets under management over the last 14 years has grown at an annualized rate of around 18%. Means for last 14 years, year after year, it has grown at the rate of 18%. In comparison, the AUM of the Indian passive industry, which is ETF plus index funds, has grown at an annualized rate of 45%, which is really very good. And most of the growth has happened in the last 7 years. I think the inflection point was in August 2015 when EPFO started investing in equity through the ETF route. That's when the actual growth started. I think that time the size of the industry would have been around 8 to 10,000 crores. From 8 to 10,000 crores, we have grown to 5 lakh crores in about 7 years. Now, what is the mix of, basically, as I mentioned, we have ETFs in equity category, we have in fixed income, commodity, and others. So globally, if you look at of the total assets of 8.85 trillion US dollars, 73% is in equity ETFs, 17% is fixed income, which is represented as FI over here, 10% in commodity and others. In comparison, the Indian classification of mix is also very similar, 74% in equity we have a higher proportion in fixed income, which is 22%, and 4% is in commodity. Now, if you look at the global markets, the maximum assets are in US. US markets account for 70% of the global AUM of 8.85 trillion. European markets account for 16%. Asia Pacific accounts for 11%, and other geographies account for 3%. Now, if you look at Indian markets, India is one. So basically now equity passive funds accounts for 22% of the total mutual fund equity AUM. So whatever the AUM is, around 16.6 lakh crores of that AUM, 22% is accounted for by equity passive funds. Globally, we have 10,481 ETFs and issued by around 650 issuers. In comparison, in India, we have 215 equity and debt passive funds as on March 2022, as compared to 8 in 2008. So that is the kind of growth we have seen. Now, net inflows globally in the first 6 months of the current calendar year, that is January to June 2022, has been around about $500 million. Sorry, $463 billion, not $500 million. It's $463 billion US dollars. And if you look at the Indian markets, last financial year, FY 21-22, around 1.28 lakh crores was the total inflows into the passive funds, that is ETFs and gold ETFs, ETFs, index funds and gold ETFs. And in comparison, in the first quarter itself, we have had around fresh net inflows around 40,000 crores. So if you look at the trends in the inflows, so as I said, last year, the fresh inflows into the passive, which includes ETF, index funds and gold ETFs, was around 1.28 lakh crores. That is in comparison to that in the previous year, 2021, was only 51,000 crores. So from 51,000 crores of net inflows into the passive funds in 2021, it increased to around 1.28 lakh crores in FY22. And in comparison, in first quarter, we have already seen 40,000 crores of net inflows into passive funds. And if you look at the breakup of the same, 40,000 crores is broadly 20,000 crores in ETF, around 19,000 or 20,000 crores in index funds. So that is the breakup. So this is a summary. In summary, the comparison of global ETF industry versus India passive industry. Now, the numbers now in subsequent slides, I will break it up into, I will show the numbers for ETF separately and the index funds separately. And that's what we'll talk about. So this slide talks about the growth in the Indian ETF industry. So if you look at the numbers, the growth industry, the Indian industry in last 14 years has grown, Indian ETF industry has grown at the annualized rate of 42% per year. From March 2008 till June 2022. So the assets of the ETF, the assets under management is around 4 lakh crores, 3.97 trillion, as I mentioned on the top, and which is in dollar terms is around 51 billion US dollars. Similarly, the number of ETFs has grown 15-fold in this 14 years, from 8 numbers in March 2008 to around 121 in June 2022. So this numbers which we are talking about is only debt and equity ETFs. We have not. This does not include the. Gold ETFs. And if you look at the growth, as I mentioned earlier, most of the growth in the ETFs and index funds has happened over the last 7 years, starting from August 2015 till now. So if you look at only the 5-year period, that is July 1, 2017 to June 30, 2022, the AUM of ETFs in India has grown 8 times, which is really excellent. And if you look at the performance of last one year, the AUM has grown by around 30%. So this table gives the annual inflows. So if you look at in the current financial year, in the first quarter, first 3 months, April to June 2022, the AUM inflows, net inflows into the ETFs has been around, debt and equity ETFs has been around 20,000 odd crores, as compared to 80,000 odd crores in financial year FY 21-22, that is last financial year. So the trend, the volumes remains more or less the same in the current year also. This is 20,000 is approximately 1/4 of the full year's net inflow last year. In comparison, in FY 2021, the net inflows were only 39 or 40,000 odd crores, And in FY 1920, the inflows were approximately 60,000 odd crores. Now, the table in the table on the right hand side, that is very interesting numbers to see. This is a number of new folios added. So last year, the total number of folios added was approximately 62.9 lakh folios. So overall folios in the industry would be somewhere around 1 crore plus, out of which 62.9 lakh folios were added in the last financial year, and approximately 10 lakh folios have already been added in the first 3 months of the current year. So this slide talks about the growth in the index funds. So today, if you look at the index funds, the size, the total assets under management is around 82,000 odd crores, rupees 82,000 crores, which is about 10.5 billion US dollars. So this industry is approximately, as compared to 4 lakh crores of debt and equity ETFs, the size of the debt and equity index funds is approximately 82,000 crores. And so they have grown approximately at the rate of 138% per year from April 19 to June 2022. The most of the growth in the AUM of index funds has happened over the last 3 years. And over the same period, number of index funds have increased from 25 in April 2029 to 94 in June 2022. So there's grown almost 4 times in the last 3 years. And last 2 years, the fresh inflows, net inflows into the index funds has been around 67,000 crores. As I mentioned, the growth in the index funds has been in the very recent past. So out of the total AUM of 82,000 crores, the inflows of approximately 67,000 crores have happened in the current year, and another 19,000 crores have happened 67,000 crores have happened in the last 2 years, and I would say around another 19,000 crores have happened in the first 3 months of the current year. So out of 82,067 in last 2 years, that is FY 2021, 22, plus another 19,000 crores in this year. Yep. So this slide talks about the inflows in the current financial year, first 3 months, which is approximately 19,000 crores. Last financial year, about 44,000 crores. FY 2021, 4,500 crores. And year before that was around 5,000 crores. And if you look at the number of folios added, here also last year, approximately 14.54 lakh folios were added. This year, 2.3 lakh folios have been added. So, and the point we need to keep in mind is, we have already seen 40,000 crores of fresh inflows, 19,000 odd crores in index funds and 20,000 odd crores in ETF in the first 3 months, despite no new ETF has been launched in the first quarter, and only one index fund has been launched in the first quarter of the current financial year. Despite no new fund, no new ETF, and only one index fund being launched in the first quarter, we have already seen net inflows of around 40,000 crores in index funds and ETFs in the current financial year, first 3 months of the current financial. That really speaks about the growing interest of the investors in passive products. I think that is the thing to keep in mind. And we as an institution, we believe that this momentum is expected to continue in future also. So this slide talks about what is the share of passive funds as percentage of the total industry AUM. So as I mentioned earlier, the total AUM of the passive fund, which is ETFs and index funds, ETFs also includes the gold ETFs, is around 5.01 lakh crores, and which accounts for approximately 14.2% of the total AUM of the mutual fund industry as on June 30th. So 14.2% of the total AUM of the mutual fund industry is basically in passive products. And this ratio used to be just 3.8% in March 2018. So from 3.8% in March 2018, it has increased to 14.2%. And this number is very much in line with the ratios we see for the global industry. So the chart on the right-hand side talks about the same ratio for the global, and global is approximately 14.5%. So the ratios, the AUM of passive as compared to total mutual fund industry, which is 14.2% in the Indian markets, is more or less same as the global market, which is around 14.5%. And so that is where, and if you look at only the equity funds, if you look at the only equity passive funds, basically that is equity ETFs plus equity index funds, if you look at their AUM stands at approximately 22% as on June 2022, of 22% of the total equity AUM of the mutual funds, which is approximately 16.64 lakh crores. So within this numbers I have already spoken about. So today, this is only about ETFs. Within ETFs, equity segment dominates. Within ETFs, 79% of the assets is accounted for by equity, 16% is accounted for by debt, and 5% is accounted for by commodity. So if you look at the same number in March 19, 95% of the ETF AUM was equity, only 2% was debt, and 3% was commodity. This 95% has come down to 79%. That is mainly because of launch of Bharat Bond ETF, which was launched in December 2019. That's when this concept of investing in debt passive products really picked up. And after that, the debt ETFs as well as debt passive products have really become very, very significantly large. The total AUM of debt passive products would be approximately 90 odd thousand crores. And till now, basically Bharat Bond ETFs have been launched, tracking the Nifty Bharat Bond Index series, and the total asset under management is approximately 46,000 crores. So if you look at debt ETF, which used to be almost zero before the launch of Bharat Bond ETF, the AUM of Bharat Bond ETF itself has grown from 0 to 46,000 crores in 2.5 years. And so basically the question will be like, go back to the previous slide, and why this one is why the debt passive products are becoming, I think that's the question which people keep asking, why debt passive products are becoming very popular, why our investors are going for it. So there are 3-4 reasons for debt passive products, which is debt ETFs as well as debt index funds becoming popular among the investors. There are, I would say, 4 key reasons. One is predictability of returns. So basically, when you invest in any debt ETF or debt index funds, and you know what is the yield of the underlying index or yield of the fund at that particular point of time, and if you invest and if you remain invested till the end, basically today whatever debt products have been launched, they are target maturity products. Target maturity products are basically products which will mature on a particular date, just like a bond, normal corporate bond. The target maturity ETFs or index funds also mature. So basically, if you buy or invest in target maturity index funds or ETFs, and you know what is the yield at that point of time, and if you hold on to this ETFs and index funds till maturity, one investor is expected to earn similar yield. That is, predictability of returns is very high. Second is they are very tax efficient, because if you are investing in this target maturity, again, index funds or ETFs, so if you hold for more than 3 years, then they become long-term capital gain. Long-term capital gain, one pays 20% tax after adjusting for the inflation. So then the overall tax impact comes down significantly. Third is the credit quality is very good, because whatever index funds or debt ETFs or index funds have been launched till now, the underlying assets are either government securities, GSECs, or SDLs, which is state development loans, or AAA rated corporates. So the credit quality is very good. And the fourth point is liquidity. They offer high amount of liquidity, because ETFs, as I mentioned earlier, they trade on the exchange. So if you want to if you have some urgent or emergency requirement of money, you can always liquidate your ETFs on the exchange. Similarly, if you are investing in index funds, one can redeem the investments or index funds through the mutual funds. You can approach a mutual fund and you can redeem them at any given point of time. So I think these are the 4 reasons why debt index funds or ETFs are becoming very popular: predictability of returns, tax efficient, liquidity, and high credit quality. So now in ETFs, who are the major index players and what is the market share? So first I will talk about the equity ETFs. So there are about 104 ETFs listed and traded on the exchanges, out of which 81 ETFs are linked to Nifty indices, 17 ETFs are linked to BSE or Asia Index indices, and 6 ETFs are linked to other indices. So that is in brief. So basically 73% of the AUM of the equity ETFs is linked to Nifty indices, 25% is linked to BSE or Asia Index indices, and 2% to other indices. And the total asset under management of equity EF is around 3.3 lakh crores, out of which 2.28 lakh crores is benchmarked to Nifty indices, 1.72, and out of which 1.72 lakh crores is benchmarked to Nifty 50. So Nifty 50 accounts for almost 45% of the total equity ETFs AUM, and 96,000 crores is benchmarked to BSE indices, and 6,600 crores is benchmarked to the foreign indices. Now, coming to debt ETFs, we have around 17 debt ETFs which are available and traded. And the total AUM of the 17 ETFs is around 66,000 crores. And these are benchmarked to 16 Nifty indices. And the popular indices are Nifty Bharat Bond indices, which have assets of around 46,000 crores. Next is Nifty SDL. SDL is State Development Loan. April 26 means the index and the underlying ETF will mature in 2026, April 2026. Top 20 equal weighted. So this is the name of the other indices on which debt ETFs are available. Now, which are the most popular ETFs or indices on which ETFs are available, and what is their AUM in India? So number one is Nifty 50. As I mentioned earlier, there are 17 ETFs which are tracking Nifty 50, and the assets under management of Nifty 50 is around 1.72 lakh crores. Approximately 44% of the equity ETF AUM is linked to Nifty 50. Next is S&P BSE Sensex, 9 ETFs. Assets under management is 88,000 crores. Third is Nifty Bharat Bond Index Series, 5 ETFs, 46,000 crores is the AUM. AUM is assets under management. Then Nifty Bank, which is again very popular, 9 ETFs, assets of around 23,000 crores. Then Nifty CPSE, which was the ETF launch by the basically government of India, used this ETF for a disinvestment purposes. And there is one ETF, the assets under management is 17,000 crores. Then we have S&P BSE Bharat 22, one ETF, 8,000 crores. So these are the top 10 indices in terms of AUM, and this top 10 basically the ETFs tracking this top 10 indices account for 95% of the total ETF AUM. And so this is there, and the largest debt ETF tracks the Nifty Bharat Bond Index Series. Now, similarly, what are the top 10 index funds and what is the AUM in India? So number one again is Nifty 50. Nifty 50, there are 19 funds. The assets under management is 21,900 crores. Next is now good to see that next three are the debt indices. So in index funds, the after equity index, which is Nifty 50, the top three in terms of AUM are debt indices, Nifty PSU bond plus SDL April 2026 50/50. So please don't get scared. Let me just explain what exactly this name means. So Nifty PSU bond plus SDL, that means the index has got PSU bonds and then SDL is State Development Loan. And April 2026 means it is maturing in 2026. If you invest in this index fund, the index fund will mature in April 2026. And 50/50 means 50% of the assets are invested in PSU bonds and 50% of the assets are invested in SDL bonds. I think that's what this index means. I thought it's good to explain it now because you will keep coming across this name because a lot of new such indices are being created, new products are being launched around these indices. So this is what the jargon stands for. Similarly, if you look at Nifty SDL plus PSU bond, again, it is SDL plus PSU bonds maturing in September 2026. And the ratio is 60-40, means 60% will be invested in SDLs and 40% will be invested in PSU bonds. And that is there. Then again, the third is CPSE. CPSE again is PSU bonds plus SDL, September 2026, 50/50 is the ratio. So these three index funds have an assets under management of 6,000 crores, 5,000 crores, 5,000 crores. The next popular is again the equity, Nifty Next 50, which again is a very, very popular index for mutual funds to launch index funds and or ETFs. And we are seeing a good traction over here also. There are 12 index funds which are tracking Nifty Next 50. And which has assets under management of 5,000 crores. Then S&P BSE Sensex 6 index funds, assets of 4,500 crores. Then CRISIL Gilt 2027 index, Nifty PSU bond. Again, next three are debt indices. So point to note is in top 10 indices in terms of AUM, are six are debt index funds. I don't think 2 years back we would have ever imagined that in passive index funds, out of top 10, 6 indices will be debt indices. This is really very heartening, and that really makes us feel very happy. So that makes this shows that even the debt passive is becoming, while it has been launched very recently, 2.5 years back, but debt passive products are also becoming very, very popular amongst the investors. Now, this slide is slightly overcrowded, but the idea to show this slide to all of you is just want to show that there are 54 indices on which various ETFs and index funds are available. So there are, on this 54 indices, we have 104 ETFs, 72 index funds, and total assets of both this put together is 3.71 lakh crores. So definitely, yes, Nifty 50 is the most popular. Out of 3.71 lakh crores, almost 50% is accounted for by Nifty 50, which is more than 50% actually, 1.94 lakh crores. Next is BSE Sensex, which is approximately 92,000 crores, which includes both ETFs as well as index fund. Third is Nifty Bank. But I want to bring to your notice is today you have wide variety of indices on which this ETFs are available. So you have ETFs and index funds available on broad market indices like Nifty 50, Nifty 100, Nifty 50 equal weight, Nifty 100 equal weight. Then you have Nifty 500, Nifty small cap, mid cap, 150, Nifty 100. Then you also have ETFs available on various strategy indices like Nifty 200, Momentum 30. This again is becoming very popular. A lot of new products are being launched on this. Then we have Nifty 100 low volatility 30. Nifty 100 low volatility 30 means that out of Nifty 100, all the stocks, 30 stocks with low volatility have been taken in this index, and index has been created. And we have two products available on this, two ETFs with an asset under management of 1353. Then we have Nifty Pharma, Nifty Auto, Nifty India Consumption, Nifty India Manufacturing. Then we also have on Nifty Small Cap 50. So I'm just reading out this name just to tell you all, to tell all the listeners that you have a full bouquet of indices on which ETFs or index funds are available. You as an investor need to decide whether you want to take exposure to large caps, you want to take exposure to mid cap, you want to take exposure to small cap. And once you have taken that decision, then you can choose the underlying index. If you want to go to large cap, then you choose Nifty 100, Nifty 50. If you want to go to mid cap, you can take Nifty mid cap 50, Nifty mid cap 150. If you want to go to small cap, take Nifty small cap 50, small cap 250. Or you want to go into strategy, you want to go for low volatility, alpha, PSU bank, you have banking sector, then you have financial services. So it's all up to you. What is your investment philosophy? Based, once you have decided that, you have decided on your asset allocation, you can choose the underlying index. And once you have decided the index, then you can choose the particular ETF or index fund, which is tracking that index. So I think so there's a wide variety of indices on which we have equity indices, equity ETFs and index funds available in the market. So again, this is just to show a slide how popular ETFs and index funds are becoming. So last 3 years, just showing that in last financial year 21-22, 31 ETFs were launched in 1 year. One financial year, 31 ETFs were launched, and wide range of indices. Last year we had 3 ETFs being launched on Nifty Healthcare, 3 ETFs being launched on Nifty India Consumption, then 2 on Nifty 5A benchmark GSEC indices, then 2 on Nifty Auto, then Nifty Midcap 150 quality. So a wide range of indices on which ETFs were launched. 31 ETFs were launched last year. Then year before that, we had 16 ETFs being launched in financial year 2021. So in 2021, we had 16 ETFs launched, and in the next year, the number of new ETFs launched increased to 31, almost double. And year before that, there were 12 new ETFs launched, that is in financial year 1920. Again, a wide variety of indices: Nifty Private Bank, Nifty S&P Sensex Next 50 Index, Nifty Midcap 150, Next 50. So you have a range of indices on which products are being launched. So this slide talks about the trading volumes of ETFs. So here also the trading volumes have been increasing. So the bubbles which you see on the top, that talks about the average daily trading volume. So average daily trading volume, the way to read the slide is the last slide, the last right side on column, which is in the first 3 months, average daily trading volume on NSE in ETFs was around 372 crores per day, as compared to 352 crores per day in financial year 22. Before that, the average trading volume in FY21 was around 264 crores. If you look at the mix this year, equity accounts for 52% of the trading volume and debt accounts for 42%. As compared to that, last year, equity accounted only for 43%. The proportion of trading volumes accounted for by equity has been going up, and even the average daily trading volume has been going up. As I mentioned earlier, the ETFs trade in the cash segments. Now, other few things which are not there on the slide, which I thought I should share with all of you. And now again, I think a lot of you might think that this equity ETF turnover is accounted mostly for by institutional investors. That is not the case. So in financial, if you analyze the data for financial year 22, that is 352 crores per day, average trading of 352 crores per day. So the retail investors accounted for 52% of the total trading volume. So retail investors accounted for 52% of the trading volumes in FY22, as against that prop accounted for 28%, and institutions accounted only for 20%. So it is again heartening to see that retail investors are trading in that. A lot of us think that it's the institutional and prop which are trading. No, even retail investors account for majority of the ETF traded on the NSE. Now, similarly, what we have seen, it has come to our observation that in cash market segment, as I said, that ETFs trade in cash market segment, one out of every three clients has traded in ETFs in financial year 22. Which again, when this number was told to me, it was difficult to believe, but it is very heartening to see that one out of every three retail investor who is trading in the cash segment is trading in ETFs. So retail accounts for 52% of the total ETF traded on NSE platform, and one out of three retail investor or one out of three trader or investor client has traded in ETF on NSE in financial year 22. So I think that was in brief on the trading volumes. Now, as we have seen, the industry has been growing. The net inflows into the ETF has been increasing. Today, the passive accounts for almost 14% of the AUM of the mutual fund industry, as compared to only 3.8% 4-5 years back. And we believe that this growth will continue. The investments in passive will keep increasing. And what will drive this growth? One is increasing awareness amongst retail investors. We ourselves at NSE are conducting a lot of such sessions to create awareness about passive investing among the retail investors. Today's session, I think, is 4th and 5th as part of our investor education. We are conducting dedicated sessions only on passive investments, and we will continue to do that throughout the year. So one is, and that is increasing awareness amongst the retail investors. And second is reducing alpha between active and passive funds. So basically, why do we invest in active? Basically, we as an investor would like to invest wherever we get higher returns. And it has been seen that there have been a lot of studies which have been done. Majority of active funds, and especially in the large cap category, they are not able to outperform the indices. So basically, as all of us know, the expense ratios in passive funds is very low. It could be anywhere between 0.03, 0.05% to 0.5%. As compared to active fund, the expense ratios are about 1 to 2%. So despite paying higher expense ratios, majority of the active funds, especially in the large cap, are not able to outperform the indices. That means the returns they give, which are lower than the underlying index or the benchmark index. The third is the pension fund investment in equity through ETFs. As I mentioned earlier, the inflection point for ETFs or the passive was in 2015, exactly August 2015, when EPFO decided to invest in equity through the ETF route, and pension funds are becoming one of the large investors in the passive through the equity ETFs. And increasing popularity of debt ETFs and index funds. As I mentioned, the debt investments in passive started picking up in December 2019, and in 2.5 years we have seen inflows of almost 90,000 odd crores, which is really thing. Then the last one is significantly lower expense ratios that will also attract institutional investors. Market makers can play a role in improving liquidity. Market makers play a very important role in liquidity. And also the last one is, as I mentioned earlier, a lot of new passive products are being launched, and we are seeing passive products being launched on different kinds of concepts like debt funds in equity, different kinds of indices, then multi-factor, ESG, global indices. That will also result. And last, I think regulators also giving a lot of focus and attention to development of passive investment, passive funds. And recently SEBI had come out with a fresh set of guidelines for development of passive funds, which we believe will go in a long way in overall development of the passive funds in the country, because that is required, and even everyone is focusing on that. Passive industry is expected to grow, and we believe that the growth momentum will continue as we move forward. So this is just a line by John Bogle, who is the founder of Vanguard. Where returns are concerned, time is your friend, but when costs are concerned, time is your enemy. So basically, costs are concerned, time is your enemy. So one need to look at cost also when investing in funds. So thank you very much for your time and patience. So I'm through with my presentation. So we will open the house for question and answer.
Thank you, sir. Thank you, sir, for your session. Now I request Rohit sir to start the Q&A session.
Rohit? Rohit, can't hear you. Rohit? Mir, is Rohit there?
Yes, sir. Rohit sir is there.
But we can't hear him. Is you on mute or something?
Yes, can you hear me now?
Yeah, Rohit can hear you now. Sorry.
Yes. So Mukesh, thanks a lot. Thanks for the wonderful presentation. I believe all the attendees might have definitely gained from data and insights which were presented. So we have almost 10 minutes now, and we have a lot of questions. So I will try to quickly club those questions and ask you whatever we can in say next 10 minutes.
Okay, thanks.
So a number of users have asked how to, because there are so many funds, so many ETFs, so many index funds in the market. So if somebody has to select which ETF or which index fund to invest in, what are the parameters? How should they go about it?
So I think I briefly touched upon this during my presentation. So basically now there are so many ETFs, so many index funds available. Now, how does one go about where to invest, what to invest? I think first of all, the main thing will be asset allocation. So whether I want to go into debt or I want to get into equity, I think that is first. And now once let's say you've decided in equity, one has to look at what is the asset class in equity, whether I want to go for large cap, I want to go for mid cap, I want to go for small cap. That is the decision one needs to take. And once that has been done, then you decide which is the index. Index is, as I said, in large cap, we have Nifty 50, Nifty 100. So you have to decide whether you want to invest in a basket of top 50, or you want to invest in a basket of top 100, or you want to invest in the basket of top Nifty next 50. Next 50 is top 50, and out of 100, then remaining 50 is basically the next 50. So one has to select that. And then based on that, once you have decided, suppose as an investor, I decide I want to invest in Nifty 50 to keep the whole thing very, very simple. I want to get market returns. Nifty 50 is the most popular index. So I have decided to invest in passive product underlying Nifty 50. Then, as I said, there are 19 index funds available linked to Nifty 50. There are 17 ETFs linked to Nifty 50. One should look at what is the tracking error. Tracking error, as I mentioned earlier, difference between the fund returns versus the index returns. Then second is the expense ratio. The lower is the expense ratio, the better it is. Lower is the tracking error, the better it is. Then the size of the fund, the bigger is the size, the better it is. So I think these are the three things for looking at index fund. Now, if someone is want to invest in ETF, then for ETF, one should also look at what are the trading volumes. And because when you go to buy, you should not unnecessarily buy something which is more expensive than the live NAV. So NAV, one should check the NAV of the underlying ETF on the fund house website, and I believe now it will also be available on the exchange website. So one should look at what is the live value of the fund and at what price it is available. So one should try to buy the ETF which is available close to the live INAV or live NAV, plus the bid ask spread, the impact cost of the underlying ETF should be low. So I think one has to keep on all these parameters based on which one can select which index funds or ETFs to invest. Similarly, if one wants to invest in debt fund may, I think, as I mentioned earlier, most of them are target maturity passive products. So one has to decide what is the time period for which I want to lock in my fund. Suppose I don't need funds till, let's say, April 2026. Once I've decided that, then I will look for indices which are available around that time, which are maturing around April 2026 plus minus few months. And once I have done that, then I need to decide whether I want to invest in SDLs or GSECs, which are the most risk-free, and these are sovereign risk, and then or I will go for PSU, and then accordingly look at the expense ratios and tracking error, and then one can select the index fund basically, or ETF. That is how one should go for selection of index funds or ETFs.
Sure, Mukesh. So another question is on smart beta indices and the products which are tracking these smart beta indices. So the question is, can you throw some light on these smart beta indices and retail participation in the same?
So basically, I had taken some of the names during the presentation. So basically, smart beta, or I'll call strategy indices. So strategy for an investor could be, let's say, momentum. Momentum is the stocks which have given higher returns or which have grown or which have given good returns in the last few months. So depending on what is your time frame, that is the momentum. So we have an index called Nifty 200 Momentum 30. Out of Nifty 200 stocks, the stocks which are part of Nifty 200 index, we select top 30 stocks based on last 6 months and last 1 year momentum of returns, and that index is created. So that is one strategy. Second strategy could be on alpha. Alpha is comprising of stocks which have given higher returns than the market returns. So that index will comprise of stocks which have given higher returns. Or if someone wants to go for low volatility, so we have an index on, as I mentioned earlier, Nifty 100 low volatility 30. So one can go for that. Or someone wants to invest in value stocks. Currently, a lot of people are talking about, given the market volatility and already the markets are going down, so one should invest in value stocks. So there are indices we have in value indices also, Nifty 50 value 20 and other value indices on which products are there. So people can invest in those value indices also. So strategy, depending on what strategy an investor wants to take, he or she can choose the index and invest in the ETF or index fund which is tracking that. And also one needs to keep in mind is there is no one strategy which will always work across or through the cycles of the market. One particular industry will work in a particular cycle, and in next cycle some other strategy will work. So accordingly, the investor needs to keep that in mind before taking or deciding which particular strategy to invest in.
Thanks, Mukesh. Yeah, thanks, Mukesh. Now I'm clubbing few questions because there were a number of questions on debt passive products. So people, what they are asking is that because they are saying that earlier all the passive products generally were on equity indices like Nifty 50 and Nifty Bank and all. And recently there are a lot of passive products on debt indices also. So the broad question is, what's the view on these debt passive products and how it's expected to grow in coming years?
Okay. No, I think we have already seen the growth. As I mentioned earlier, in December 19, the AUM tracking the debt passive products was very, very low. And those are also two products were there, which were many products were there, but main assets were in two products which were linked to overnight index. So, and the debt passive has become very popular over the last 5 years. And that is mainly, as I mentioned earlier, because of four reasons. One is liquidity, tax efficiency, high predictability of returns, and good credit quality. So for an investor's point of view, I personally believe that it is a very good product because if you have to compare them with, let's say, bank fixed deposits. So bank fixed deposits also today, I go and make a deposit in the bank, and I know that I'm going to invest in the bank deposit for 3 years, 4 years, or 5 years, and this is my rate of return. But if you look at it for tax point of view, especially for people who are in the higher tax bracket, because your taxation on the interest on bank FD is at your marginal rate. So whatever, if I fall into 10% bracket, whatever interest I earn, I have to pay 10% tax on that. If I'm in 20% bracket, I have to pay 20% tax. If I'm in 30% bracket, I have to pay 30% tax. Vis-a-vis that, if you're investing in the debt passive products, as I said, if you invest for more than 3 years, it becomes a long-term capital gain, and long-term capital gain tax is only 20%. And that also after you've done the after you have adjusted for the inflation. So effective tax rates really come down significantly. So that is one of the biggest advantage. Second is, as I said, credit quality, because whatever products have been launched so far are all either government securities, GSECs, or SDLs, which are sovereign credit, or AAA rated PSUs. Again, the credit quality is very good, so credit risk is minimized to the extent possible. And liquidity is very, very good, because if you look at bank FDs, once you have locked in for 3 years, 2 years, whatever period you invested in, it's difficult to get exit. If you break your FD in between, you have to pay some premature withdrawal penalty. Whereas in this case, if you have crossed the period beyond which there is no exit load, you can always liquidate, because you can always go back to the mutual fund and liquidate. So given this inherent advantages, we believe that debt passive products are going to become very popular. They will be, I think, investors will be looking at investing in debt passive products. And we have also seen that even the institutional investors have started investing in corporates, and institutional investors have started investing in debt passive products. So the growth momentum in debt passive products is expected to grow. And we also know that based on the number of indices, or the number of indices on which we are working for the launch of debt passive products going forward. So there is a huge demand for that, and we believe that these products are going to become popular going forward. Yes, Rohit.
Sure. Thanks, Mukesh. There is one question which says why ETFs are, because ETFs are very popular in global markets. The question is why ETFs are not so popular in India yet.
Okay. There are 2-3 things. One is ETFs. One was, I think, lack of awareness and popularity. So that is increasing. So that way they are becoming popular. And second thing is today, a lot of people and retail investors and all don't have the demat account, because demat account is needed to hold ETFs. So a lot of investors don't have demat account. And these are the few reasons, I think, 2-3 reasons, because it's not becoming popular. But I think at least we believe that going forward with the increasing awareness, new products being launched, then inability to generate the alpha over the indices, over the benchmarks, they will drive the growth of ETFs as we move forward. And some of the recent developments and guidelines issued by SEBI will further increase, or will further make the product popular as we move forward.
Okay. And maybe one last question, because we are running out of time. People are again, I'm clubbing few comments, few questions. People want to understand whether this growth in passive like ETFs and index funds will continue, like it has happened in last 4-5 years. AUM has grown a lot in both ETFs and index funds. The audience wants to know whether you feel that this growth will continue for the passive industry.
Yes, I think so. Because as I said earlier, we have seen last 7 years, the industry has grown almost at the rate of 42%, 14 years at the annualized rate of 42%. And we expect the momentum to continue. We are seeing a lot of interest from the issuers, that is the fund houses, for launch of new products. And even a lot of push is happening in the market from the distributors, etc. So the momentum and the growth rate is expected to grow, and we believe that. And there are inherent benefits, as I spoke earlier, the inability to outperform, lower expense ratios, given the benefits of the passive investments, which has been the trend overseas. So we expect the growth momentum to continue.
Sure, Mukesh. Thanks a lot. I think we have run out of time now. So maybe with this, we will close the session. Thanks everyone for joining. We hope that the session was useful. We will continue with this session on
Rohit, you are breaking.
Fourth session, passive investments. We will continue our journey on this interesting road, and we look forward to interacting with all of you again with on the same topic. Thanks a lot.
Thank you, everyone. Have a good evening. Bye.
Thank you. Bye.